Rashesh Shah, Chairman of Edelweiss, also joins us live. Rashesh, good afternoon to you. Thank you for joining us. Rashesh, what has spooked the rupee?
No, I think as we have always been saying, the stress has been there because there is a current account gap, and I think increasingly, the kind of all the government action trying to fight and protect the rupee is creating even more stress. So I think there is a structural trade account gap that we have. As a result of that, I think the rupee needs to find a some stability on its own. The more we are artificially trying to force stability out there, the markets are getting more and more uncertain.
Are markets worried about capital controls? That's my understanding. When I spoke to some big fund managers, they feel that the moves which have come on Wednesday are rather draconian.
No, I think capital control is a strong word because, what they've done is they've reduced $200,000 to $75,000 from 400% of net worth to 100%. So it's not like capital control of the old days where we couldn't, get foreign exchange for travel abroad and all of that. So I think India has opened up. And as long as I saw in the morning today that the government said these are temporary measures, these are temporary. They are not ideal, obviously, because they are slightly going back. But on the whole, I wouldn't go back to say that India is now under capital control of the pre-1991 days. I don't think we have gone there, but these are not, it's not happy times in India.
The market did start off on a weak note today, Rashesh, but post-Europe opening, post-130, this fall has only become even more severe. Is the sense also that, with a Fed policy meet slated for September where expectation of QE tapering is riding high, the market is pricing in that nervousness?
Yes, I think a large thing that happened because we had a holiday in between. I think the U.S. Employment figures have come out well. The U.S. 10-year has again bounced up. The yield has gone to more than 2.8. And I think that has been one of the key catalysts. And as we have always maintained that India has its own set of problems, but at the same time, all emerging markets are going through a stressful, period because of this expectation of the Fed tapering and the global interest rates going up. And India is getting, India is also suffering because of that, but we are not alone. I think all emerging markets and all global equity markets for the last few days have been soft.
Right. One more aspect, Rashesh, is that when we speak to fund managers, they're often talking about how the rupee is in oversold territory, given the significant fall. So, with the rupee being oversold, with valuations being between, 12, 13 to 14 times 1 year forward, the combination of those two factors, isn't that building a compelling case to buy India right now?
I think from a fundamental point of view, absolutely true. I think, from a very fundamental point of view, India still, I think, is an attractive from the medium to long-term investors' point of view. I think currently the mood amongst investors is to try and be safe and play defensive. So even in Indian equity markets, I think the only sectors they're finding favorable are IT and pharma, which will actually benefit from the rupee fall and the U.S. markets doing well and all of that. So I think people are being defensive until we find that there is some sort of stability that comes back at the global liquidity flows angle as well as on the India side. So I think until then, though it's a compelling case, I don't think people will come in a hurry.
Rashesh, at the current juncture, I guess it's very easy to make a bearish argument. Nothing is going our way. Growth expectations have got reset. Earnings are not strong. Flows could be a challenge. But in times of adversity, there always lies a big opportunity. So where is the big opportunity?
No, I think opportunity will come. As I said, there are some pockets of the market, like the consumption story is still strong. Given that the monsoon has been good and agricultural production is going to be very good, consumption story, rural-oriented consumption stories will still do well. IT sector, pharma sector, they are doing well, and I think they are also still not, at least the IT companies are still not very overvalued. So I think investors are finding refuge in that. But the larger part, the banking sector, the infrastructure, the capital goods, all of that are facing the impact of the economic slowdown, as well as the recent RBI move to raise interest rates. which I think has created a lot of concerns about corporate earnings as well as asset quality.
Everyone has a different number on FY14 GDP number. I've got a range of about 5.8% to about 4.5%. What is your GDP number for FY14?
I think our guys are still working on it, but I think most of the consensus is that it will be around 5, between 5 to 5.5. But we still have to see, the RBI liquidity measures that have been announced, they are very significant and they have a huge impact on the economy. Like effectively, the rates have gone up by 300 basis points. Usually a 300 basis point rise should result in GDP falling by at least 100 basis points, about one-third of that. So given that, I think if this continues beyond October, the liquidity tightening and the high interest rates, then you should see, GDP growth numbers being scaled down even further. So it's a fairly dynamic situation, and we are all hoping that the liquidity tightening gets over at least by September, and it should not get carried forward to October.
Right. So how are you viewing what happens on rates over the next 6 months, Rashesh, in terms of, whether there'll be a pause or a potential rate hike? And, how would that be reflected in the market's performance over the next 6 to 12 months?
Well, I'm hoping there is no rate hike because effectively rates have already gone up by 300 basis points on the short end and about 150 basis points on the medium to long end. And along with that, I think the liquidity has got very tight. Everybody is hoarding liquidity because, nobody knows how bad this will get. So I'm hoping it will not get worse because I think anything more than this, because anyway, this liquidity tightening measures have not helped the rupee, which was the original objective. So I'm hoping it won't get worse. The key question is how long will this continue? The current state of affairs, if it gets over in the next few weeks, then we are okay and things will not, I think be as bad as everybody is, predicting. But if this goes into October, then the collateral damage to the economy, asset quality in banks, corporate earnings, all of that could be fairly significant. And over the next 3-4 quarters, even that will get unfolded. And I think that could cause a lot of harm to the economy.
Rashesh, how much of today's price damage or recent price damage in equities, in the rupee, in the bond market is a function of speculative froth? It is a function of global liquidity. And how much of the price erosion or price destruction is a function of fundamental and valid concerns?
I think it's largely fundamental and the valid concerns. And I think, as I said, this is a global issue because global liquidity is getting tightened. All emerging markets are slowing down. All the developed markets are doing well. So there is a portfolio reallocation also going on away from emerging markets into developed markets. And I think given India liquidity, inflation figure that came out day before yesterday was high. So given the macroeconomic parameters which are weighing on the market, I would strongly believe that this is basically fundamental reallocation because there is a fair amount of concern on the economic slowdown and the issue with, availability of bank credit, issues around credit quality, all of that. So this will be fairly significant.
Right, Rashesh, really appreciate your time. I know we've managed to catch you in between your travels, so really appreciate your time and enjoy your stay at Jaipur.
Okay, that's another market view coming in since we've got